Todd Horwitz, founder of AverageJoeOptions.com, joins me now from the CME. Let's start first with the fact that gold prices reflect this risk-on, risk-off trade, with risk clearly coming off a little bit on Friday, and the prospect of the Federal Reserve increasing interest rates as soon as June. What is the prospect for a safe haven trade of gold versus, say, treasuries?
Good morning, Scarlett. I think the first thing when I look at gold as more of a true commodity. It really isn't the currency that we all like to make it out to be, but I think that it's a great spot and a great investment. And I think as the Fed has indicated, well, maybe not the Fed, but as the Fed funds rate says, interest rates are going to go higher, it put a tremendous amount of pressure on gold, but really because of the overall strength in the U.S. dollar. The dollar is becoming way too hot, forcing commodity prices down, especially ones like gold. Now, I think that gold itself has taken its best shot from this real strong U.S. dollar, and I can't see the dollar getting tremendously much more stronger based on what's going on with the global economy. So I think gold's in a real sweet spot here. It could go down and test its low of 1160, 1140, but I think here's a great spot to start buying gold again.
And what's your outlook then? What kind of price range are you looking for gold to trade at within 6 months to a year?
I think in the next 6 months, gold will probably, I could see 1,300 to 1,400 in gold. And on the downside, I can only see it going probably down just near 1130 or 1120. So I think the risk-reward model says gold's probably a pretty good safe haven play here because we want to be in some alternative spaces anyways, as money will start to come out of the equity market as this bull market gets long in tooth. And I think gold is a spot that a lot of places people will be targeting to get into. So I'm going to buy gold here at this around 1170 level. You know, 1160 or 1180, I have no problem. I think our first target is 1200 to 1220, and then I think we can see a run back to that 1300 we saw earlier in the year.
All right, let's just put your trade in layman's terms right now. You'd be a buyer of gold at the current price is 1172. Let's just call it 1172. It's 1172.80 at the moment. You think gold futures are headed back to at least initially $1,200. That's a move of $28. Gold trades in contracts of 100 ounces. So, Todd, you'd be making a profit of $2,800 per contract on this trade. Looking ahead, we've got retail sales numbers this week. We've got the FOMC announcement coming up at the end of this month. Do we expect that gold will kind of trade range-bound and dependent so much on where the dollar goes?
You know, I do think that that's probably the case, Scarlett. You have gold, which is very dependent on what the dollar's doing. But again, in my opinion, gold has taken a great shot, you know, like a great boxer. It's been pounded down because of what's going on, and now the possible Fed funds, raising rates, which would put a little bit more pressure on gold. But I think it's seen the lows. I think it's taken the best that's to be given to it. So I think it does look to work higher. Range bound to higher would be my best call.
Range bound to higher. All right, let's get to the word of the week right now. When we talk about trading futures, we often hear or use the word spot. Can you explain what that means in the futures world versus in the cash world?
Sure. There's two terms, spot and cash commodity, which is the same thing. What happens is when the future expires, it goes to what they call cash or spot. So when you get a quote, like, for example, on gold right now, if you go to your gold dealer and want to buy physical gold, they will give you a price based on spot gold, which is actually the real cash in which we have to go out and buy it for, and not the future price. The futures usually trade at a premium to spot. So when you're getting your physical gold, you get the spot price plus the commission or whatever that the broker charges. But it's spot or cash, and when every commodity or future settles, it settles to the spot or the cash price.
Got it. All right. Todd Horwitz, thank you so much for joining us from the CME this morning.